Welcome back. SBI Cards, that's a company that got smacked back on Friday, post a weak set of numbers. To understand what's the outlook from here on, we're joined by Mr. Rama Mohan Rao Amara, the MD and CEO at SBI Card. Hi, Mr. Amara. Morning. Thanks so much for joining in. Well, I recall when we chatted a few months ago, you were telling us that revolver as a contribution should be steady at around 33% odd. That's come down to around 24%. So what's the way ahead on this? Where does the contribution go to? Point number one. Point number two, on your margins. You know, the system only has seen an increase of 190 basis points. Your costs haven't gone up by so much. So what do you expect the NIMs to be at going ahead? A rough number.
Sorry, the volume is very low. I'm not able to hear the question.
Is it better now, Mr. Amara? Is it better now?
Slightly, but still,
am I audible?
The volume has come down.
Am I audible, sir?
Can you hear me?
But pretty low, pretty feeble.
Okay, Mr. Amara, can you hear me?
No. Okay, all right. We'll come back to you. We'll come back to you, Mr. Amara.
Maybe we speak to Mitesh first and then get back to SBI Cards, because the market at this point in time has retained most of its early morning gains. So maybe a technical check is called for. Yeah, Mitesh is with us. Mitesh, thanks a lot for joining us again. What stocks or index are you picking up?
Yeah. Although the market is, opened strong and has remained strong. There's a mild blip, though I think that's not a big one. But Titan is something which has hit a fresh high, so that's a buy. Keep the stop below levels of 2740 and look for targets of around 2830, 2850 on the upside to begin with, and maybe even higher levels eventually. The other stock which I like is ITC. After a few days of consolidation, is moving up on the upside. It's moving on the upside, so that's a buy with a stop at 346 for targets of 360.
Okay, got that. Thank you very much. Anything on the short side at all? I mean, Bandhan has lost a lot. Intellect Design. No shorts for you, Mitesh?
Yes, so I think Intellect is clearly broken down with a big gap, and my only worry is that Lata, if you short it down 10% lower, you might actually see some kind of a pullback and you might get stopped out. So it's not a very good risk-reward entry point, but otherwise that's a stock which I think will head lower in the coming days and maybe head towards 400. Same case for Bandhan, down 8% already, so not the best level to initiate a short position right now.
Okay, we'll leave it at that. Mitesh, thank you very much indeed for joining us, and of course we'll touch base with you later in the morning. We will be getting the SBI Cards management in a minute now. Just wanted to develop on the revolver credit point that Nigel was making. Basically, for a credit card business, revolver credit is extremely useful because these are people who are not paying up and they are continuing to revolve their credit. They are charged higher. So that is directly related to the margins that the company can post. And therefore, for SBI Cards itself, the revolver credit had actually declined. They used to run as high as 45 in Q1 last year, and now it's fallen to, in the Q2, down to 24%. So, Nigel, I think we have Mr. Amara with us. Yeah, go ahead.
All right. And Lata, it's basically maybe pre-wedding I was, in that category, the revolver. And now, in fact, you're just the transactor because it's not too much money to spend. Mr. Amara is with us. Hi, Mr. Amara. I hope you're audible now. 2 points I wanted to focus on. One is on the revolver as a percentage of your total business. It used to be 35, 40, 45% as well. You were guiding for it to be a third. It's come down to around 24%. What's the trajectory going ahead? And in that context itself, what does it mean for your margins from here on, which have come down drastically? Go ahead.
Yeah, thank you. Thank you, CNBC, for giving me this opportunity. Particularly talking about the 2% decline in September quarter in revolver from 26 to 24% is more a play of build-up in the transactor NEA. Particularly during the last 10 days in the month of September, we garnered a lot of festive spends. This has an effect of elevating the NEA. Most part of it will come back as the customer pays off. Some part of it, of course, will revolve, and some part of it will get into EMI loans, giving some incremental income. So this is a more of a base effect, at least as far as the September quarter is concerned. But having said that, if we normalize it, it's still hovering around the same range, 25 to 26%. That means the revolver has been stagnant, which is in line with the industry. I mean, the trend at SBI Card is no different from the industry. In terms of taking steps, what we are taking, we have been actually exhibiting a better risk appetite. We have loosened the filters based on the comfort that is available in the credit cost a couple of quarters back. Slowly, we started permitting the more of self-employed kind of customers who have better propensity to revolve. But definitely, it's taking time to catch up. So we are optimistic, but definitely the pace at which we were expecting has not materialized. So,
But credit cost is still high, no? If you're going to start even more riskier clients who are self-employed, what is your credit cost guidance? At 7.2, it's still high.
The credit cost, gross credit cost, if you look at for September quarter, it is at 6.2%, which is like a 60 basis point increase as compared to 5.6% in the previous quarter, June quarter. Again, for the same reason, because we garnered a lot of festive spends in the last 10 days of September quarter, stage 1 assets got built up, for which in terms of accounting norms, we have to provide it at a 1.7%, which in annualized terms is almost like a 6.8%, when most part of it is likely to come back by way of payments. With the benefit of even reversing if the base declines, if the NEA base declines by December quarter.
So you're guiding for a credit cost of how much then in the second half? From 5.6, it can go down to?
Pre-COVID period, we were operating at between 6 to 6.5%. So we are confident of keeping it below the pre-COVID cost in the long term.
Right. Just a word again on your revolving credit itself. Revolver rate, you said that has been around 24 to 26%. It hasn't increased the way you expected it to. You are taking steps out there. Can you give us a bit of a timeline as to by when do you expect it to hit that 33% mark? Or, is it not likely to hit that 33% mark in the next 12 to 18 months? Can you give us a sense of the timeline?
Well, it's difficult to you kind of mentioned the timeline by which it will happen. But some of the trends, what I've seen is the revolver in absolute amount has been increasing quarter on quarter. Of course, it has not kept pace with the growth rate of NEA, but otherwise, absolute amount, it has been increasing. And even internally, when we did some analysis, I think the percentage of customers in terms of number of customers who are opting for revolvers has more or less remained stable in the last 1 or 2 quarters. So I can only presume that actually we are taking the right steps and it will eventually result in a kind of increase in the revolver over a period of time.
And what does that do to your NIMs? Because your NIMs at 12.3% are the lowest that we've seen for the company in the longest time. I mean, peak, we've seen numbers over 19% as well.
Yeah. NIM is, I think the NIM compression of around 80 to 90 basis points, what we have seen in the September quarter, is more a function of increase in the cost of funds. In fact, the cost of funds increased from 5.1 to 5.4%. But actually, if you normalize the base and remove the base effect, actually it has already reached 5.6, 5.7% as of September. That means we have seen around 80 basis point increase in the cost of funds for a couple of quarters, during which period the repo rate has actually increased by 190 basis points.
Yes.
So with the majority of our funding is based on like a short term and drawing bank lines, where the interest rate is linked to the external benchmarks. As and when these benchmarks get reset, we will see the transmission happening. But at our end, we also have some avenues to pass on or transmit the rate increase to the customers as and when we make new disbursements. So directionally, NIM may get compressed some more. But in terms of taking steps, definitely we are taking steps to partially mitigate the impact.
Okay. Samara, we are out of time. Lots more questions. We'll try and invite you at a later date after the earnings rush. Thank you for joining us.
Thank you.
Okay, a quick check on the commodity markets now. Manisha is waiting by.
Nata, thank you. And I'll add some sweet to your show here. We're talking about the sugar prices here, where we have seen some profit taking continue in the Indian markets, while the international markets have seen a bit of an uptick coming in today. This is after India has restricted exports till October 2023. India has done that in last 4 months as well, and this has continued for the next 1 year as well. Now, the restriction is done to contain the rise in prices and ensure enough availability into the Indian markets as well. We all know that last year India did export at record volumes, and after that is when the Indian government came out and put restrictions here. The restrictions, though, are not applicable on export to EU and US, and this is CXL and TRQ. Under these terms, the export is open. So TRQ is the tariff rate quota, and under CXL, the export is happening at low to zero custom duty to European Union and to US as well. India will export sugar via permits from 1st of November. This is subject to clearance. What India will do is that they will allot a mill-wise quota. All the mills will have to approach the government or the advisory committee that has been created. And as and when the clearance is done is what they will be permitted to export. The markets are anticipating that the first tranche may be allowed for 6 million tons. The announcement for that is expected as early as today. What the industry was also expecting is that overall we might be looking at an 8 million or an 80 lakh tons tons of a quota coming in for this season year. As you have been seeing, the export of sugar from the country has been increasing. 7 million tons in 2021 was an all-time high. That was cleared on by 112 lakh tons, which was a record high as well. And this year, the anticipation is that you could be looking at an 80 lakh tons of an export for the current season year. Also, when you look at the consumption, this is going to be a record consumption year for India at 27.5 million tons. The carryover stock is going to be lower in many, many years, 15 years at least, at around 6 million tons. Last year was 8 million tons. And when you look at the diversion for ethanol, that is expected to increase as well from 34 lakh tons last year to 45 lakh tons this year. So when you look at stack up all of those numbers, it does look positive, good for the sugar as an industry. The only thing that doesn't work in favor is the sugar that has to be done under permission and is not open under OGL.
Oh, yes, that of course. Thank you very much for sugar stocks. That's really very sweet news. I don't know how much it is for consumers, though. Thank you very much, Manisha. We take a quick break. On the other side, we shift to another market, the fixed income market. Actually, this is important even for equity markets. The Reserve Bank has announced an unscheduled meeting of the MPC. Should the market worry, or is this a routine meeting for other reasons? We'll be joined by Sajid. Bit a Twitter because of an unscheduled meeting announced by the Reserve Bank of the Monetary Policy Committee. They're going to meet on November 3rd. Now, I wanted to bring your notice to the press release. It clearly says that this MPC meeting on November 3 has been called under two sections. One is 45ZN of the RBI Act and the other is Regulation 7 of the MPC regulations. Now, what does 45ZN say? 45ZN got added only in 2016 to the RBI Act. This is the act which set up the MPC. Now, the 45ZN says if the MPC fails to get to the mandated, inflation figure of 2% to 6% now, then it will call the meeting and write a report. It will write a report to government explaining why it failed, what measures it is taking, and by when it will come back to target. Regulation 7 says much the same thing. If for 3 quarters the MPC does not get to the targeted, mandated inflation, it will have to write a report to the government. A meeting will have to be called. So this meeting has been called under Regulation 7. Nevertheless, the market is worried. It's an unscheduled meeting. It comes a day after the Fed FOMC meet. So can there be an unscheduled rate action as well? Sajid Chenoy, the Chief India Economist at JP Morgan, and Soumya Kanti Ghosh, Chief Group Economic Advisor of State Bank with us. Sajid, I'm starting with you because you were in the Urjit Patel committee which actually designed the MPC. So what should we expect from this meeting? Is it only to write that report?
Morning, Lata. I think you've answered your question in the introduction. I think it's very clearly laid out in when the meeting was called that this has been called under Section 45ZN and Regulation 7. Remember, Regulation 7 says that the Secretary shall convene a meeting of the MPC under normal process to discuss the report that has to go to government. That report has to go within 1 month of when the inflation target is deemed to fail. Remember, the 9 months from January to September meant that the September CPI printed on October 12th. That means the report has to go before November 12th. And therefore, I think this is largely a formality, given the timing that the MPC is meeting on the 3rd of November and has to send that report before the 12th. The fact that it is happening the morning after the Fed, I believe, is purely coincidental. So my reading of this is very much, this is when the MPC will decide on, what it sends to the government and the 3 parameters that you laid out, what the reasons for the failure were, what remedial actions are being taken, and what time frame the MPC will bring inflation back into its target range.
Okay. Well, a similar question to you, Soumya. Good morning and thank you for joining us. I already have your report, and in your report, you are saying very much what Sajid just said. Do you also think that the markets need not worry about a rate action on November 3rd?
Yeah, thank you, Lata. Good morning. No, I think I share the same views with Sajid, and you also actually laid out the facts very well at the beginning. So the report has to go by November 12th, and the meeting which has been convened on November 3 is a pure coincidence. But let me add one point also over here. I think in the past also, whenever an unscheduled meeting had taken place in RBI MPC, that was in, I think, March 2020 and May 2022, it was never announced earlier. The outcome was announced after the meeting was convened and the result of a rate cut in both the rate cut and a rate hike was declared. So I think whenever an unscheduled meetings take place, And if it is given under Section 45ZN and Regulation 7, I think it's clear that the purpose is to define and draft the report to say that why the RBI may have, why the inflation target may not have been achieved and what is the remedial action. So I think from that point of view, we should take this as an ordinary meeting where the outcome will be purely a discussion of the inflation, not the target. And also, please note, it's a one-day meeting. It's not a three-day meeting.
Yeah. Soumya, I want the equity markets to hear this loud and clear. And why? Even the debt markets. There was this odd voice worrying whether there's unscheduled meeting because it is after the FOMC meeting. Can say something. Our experts have reiterated it is only to draft the report to the government. And I also want to add, the Reserve Bank has frequently said, reminded us that they decide their monetary policy with respect to domestic events only. And an FOMC meeting will not, be a moving factor, much less to call a special meeting. Therefore, I think that fear has to be disbanded. But Soumya, do you think the little bit public? The governor said in the last press conference that it is privileged and therefore RBI will not release it. You expect government may release it?
No, I think it's a discussion between the government and the RBI. And another interesting Lata point is that the RBI actually in the last currency and finance report, which was published, I think, in 2021, there the RBI had said that instead of 3 quarters, why it is not made 4 quarters. So I think from that point of view, if I take that factor into consideration, and also the fact that it's a matter between, everyone knows that we have gone through COVID, which was an unforeseen circumstances. So I think this report is just a discussion on why it has not happened. And I don't think that this report is likely to be made public. Maybe the contours of the discussion may be discussed at some point of time, but it's unlikely to be made public at this point of time.
Oh, that would be very unfortunate as per my view, because there will be a lot of speculation on what was said in the report in the first place. Sajid, any thoughts? Should it be made public?
Lata, let me say that de jure, this is the prerogative of the RBI and the government, but de facto, there's going to be no surprise in the report, right? Let's look at the 3 parameters that you laid out. Why inflation has missed its target. Look at the unprecedented confluence of shocks that all central banks have had to confront in 2022. Everybody's missed their inflation target, right? Advanced economies, many emerging markets. And the fact is, at least till February, the RBI had thought that inflation in FY23 would be 4.5%. Market expectations were higher. They were closer to 5%, but nobody expected inflation to average 7% before the war started. So really, it was the confluence of a pandemic and a war and the terms of trade shock from commodity prices that have been responsible in part for this.
Sajid, if I may interrupt. Why they could not get to the target of 6% is perhaps the most easiest thing, because that's past tense. But look at the third point. They have to say by when it will come to target, not come under 6%. Target is 4%. I would die to read that paragraph, wouldn't you?
Right. So, Lata, 2 things again. I was going to come to the second and third part. I would say as important as by when it comes to target is the remedial action, because the remedial action will tell you, when it's expected to come to target. And I would agree, I would argue that remedial action started 6 months ago.
Yeah.
The minute the RBI figured out that inflation was going to be close to 6% or higher than 6%, we had that intermeeting hike in May. We've had 3 successive 50 basis point hikes, June, August, end of September. The MPC is still saying we're withdrawal of accommodation, suggesting more hikes on the anvil. So on the second point, my sense is the report will say remedial actions began 6 months ago when the world changed. Now, and when it comes to target, again, the last bulletin of the RBI, which was released 2 weeks ago, laid this out quite well, that there are 2 milestones to the achievement of the target. The first milestone is to first bring it down into the target range, because inflation failure is not a failure to be above 4%. The failure is when you go above 6% for 3 consecutive quarters. So the first achievement is when you bring it down below 6. Now, the RBI has reiterated time and again, if you look at that inflation forecast, that they believe this is going to happen Jan to March. They have inflation forecast as 5.8 for that quarter and 5.2% for all of next year. I would argue that an upside risk to Jan to March, perhaps we end that quarter on average above 6%. But most market expectations are that FY24 inflation will be somewhere in the 5.5% range. So again, there should be no surprises about what the RBI would
Sajid,
say.
you're not answering my question at all. I think C is the most important. I mean, their target is 4. They're nowhere near it. If they are going to say that they're going to reach 4% in 24-25, that's a serious failure, isn't it? And it contrasts very sharply with what Dr. Verma is saying, that in his minutes he says he wants it at 6%. He doesn't want a hike beyond that. Shaumya, I mean, don't you think that this should be released? And if it is going to be 4% after 23-24, that's a mark of failure. I mean, any thoughts on that?
I think getting to 4%, I mean, is always the ideal objective, but one should understand that it is flexible inflation targeting. So basically, you are targeting inflation over a business cycle. So at this point of time, I think the immediate priority is to get it down below 6%. That should be one of the steps which the RBI could actually identify. And getting to 4%, I think, is over a 2-year period. And I'm not sure that at this point of time, when there are so much global uncertainties, coupled with domestic uncertainties, I think things have not normalized. Whether it will be a correct proposition to identify that this is the time period where we can actually get down to that target. Because that's why I think that's the beauty of this entire targeting framework, whereby you are working with a flexible targeting across a business cycle, which could be volatile at any point of time.
So both of you will condone if they don't reach 4% next year. Fine. I just want to know what is your own target in terms of the 4%? Sajid, you don't see it in 23-24.
Well, the RBI is telling us that inflation forecast for FY24 is 5.2%. So clearly the target will not be reached in 5.2%. Now, I agree with you. So let me make 2 quick points. I think the lesson from the last 2 years has been, given this world we live in with multiple shocks, it's not good to keep inflation close to the upper end of the band. You know, we averaged almost 6%, 5.8 between Feb 20 and Feb 22. And then when you have another shock, it pushes it above 6%. So I would argue that we need to be much closer to the middle of that band. So if you have a shock, you don't get thrown above. But Lata, to be fair, given the confluence of shocks we're facing, it's like asking the Fed, can you tell us for sure when inflation is going to come down to 2%? No central bank can give that guarantee. It won't be credible in this environment. What's important, therefore, is not the target date. It's the remedial actions. It's important that the RBI continue down this process so that inflation expectations are anchored and you're on a glide path to get to 4%.
Fair point. Gentlemen, out of time, but if and when the report becomes public, I will have both of you and others to tell us what you make of the institution of inflation targeting and where inflation is headed. Thank you very much for joining me. Wrap up on Bazaar. Chartbusters up next.